'Tis the season for tax season. Crypto taxes are a hot topic. There's a lot of ambiguity. People aren't sure where to go for answers. People aren't even sure what questions to ask. In today's show, we're going to be asking some of those questions. And in today's show, we're going to be helping you find out where can you get the answers to some of these questions. Let's discuss. Welcome to the new space. Welcome to the new studio. We have changed it up a little bit, removing the green screen, just trying to open up the space in the studio a little bit. We have this new space. We've been doing meetups here. We've been connecting with people here, and we thought it'd be a good idea just to open up the room a little bit and to present information a little bit differently. Love to know what you think about the new setup in the show notes below. Hey everybody, I'm Gary Palmer Jr., you're you, and together we are Minting Coins, your trusted source for crypto news, interviews, and ICO reviews. Thank you for showing up. Tap that like button. It really supports us and it helps other people find this content. Also, if you have any questions or comments, leave those in the comments box below so that your voice is heard as part of the community. In today's show, we're going to be talking about crypto taxes. We're going to be talking about tax season fast approaching. Some would say furiously approaching at lightning speed. And every day closer is exponential stress that people in the crypto community are going to have as they seek to get their taxes in order, understand long-term gains, capital gains, short-term gains. What does this mean in the world of trading? What does the IRS think? What do we need to do to prevent penalties and getting ourselves in trouble with the Uncle Sam IRS tax man that is far-reaching within the United States? There's a lot happening. The world is moving very, very quickly. There's been a lot of speculation about different sort of crypto amnesties, allowing people to not have to worry about those capital gains when they make those micro purchases, less than $600, buying things like coffee and pizza. Well, those haven't materialized. We haven't had those amnesties in place yet. And so everyone is still required by US law to pay their taxes, to claim their taxes, to treat these cryptocurrencies in such a ways that are in accordance with how the IRS wants us to fulfill our end of the tax liability, of our tax obligations. And not only is there a lot of information, but there's also a lot of absence of information. So what we're going to do is that we're going to go over some top questions. We are going to go over some tools that are available for people to help point them in the right direction of how they can have the tools to maybe help get their taxes done. And then we're also going to be pointing you in the right direction where you can get answers directly from the IRS, because the IRS has memos about this. The IRS has already talked about this, and it's probably a good idea to reference their documentation about how to move forward. So we're going to review that. We're going to review a lot of information. So let's dive right in and let's discuss. So first thing, before we dive into the taxes, did you guys know that there's this 24-year-old who was jailed for selling Bitcoin without asking people for their ID? Yeah, this is happening. People are out there buying and selling Bitcoin, and people need to be careful because of the anti-money laundering laws and the KYC, know your customer laws. And people who are buying and selling Bitcoin out there without knowing the laws and understanding what they're getting themselves into, they're at a huge risk. And so U.S. law agencies can celebrate another success in their tireless crusade to stop unlicensed money transmitting in the land of the free. The latest victory is sending this 24-year-old crime kingpin to federal prison for making $40,000 trading Bitcoin offline. Kind of ridiculous if you ask us. Nevertheless, these are the laws within the United States, the land of the free, the home of the brave. And unfortunately, this 24-year-old is having his life ruined on account of this. So feel free to check this out in the show notes below, but just be very careful buying and selling Bitcoin out there in a regulated world. Okay, so on the topic of taxes, there's this article that came out pretty recently from Hacker Noon, and this talks about some of the high-level questions. So the person that created this article, like me, is not a professional accountant. They are not a financial advisor, licensed or otherwise, or a certified CFA or a certified CPA or anything to that matter. For the people in this article, and as well as us here at Minting Coins, none of this is financial advice, none of this is legal advice, none of this is tax advice. We are just going over some information, citing some sources to help put you in the right direction. So the author of this article, who also created yaxreturns.com, goes over some of the high-level Q&A, and for them to extract this information, he is referencing this IRS memo on digital currencies from March 25th, 2014, quite a few years ago. And the IRS referenced that memo again just last year on August 6, 2017. And so in that memo, it has a lot of detail, goes over a lot of Q&As, and we're going to have this memo linked for you in the show notes below. But by and large, this is what people are using to make their decisions, the memo that comes from the agency itself. So from this, we can understand, are cryptocurrencies taxable? Are they income or are they capital gains? And we understand that, yes, cryptocurrencies are taxable according to this IRS memo, and that they're taxable as income if you sell them less than 1 year of buying them. They're taxable as long-term capital gains, known as capital gains for short, if you sell them after 1 year of buying them. And according to the article, they're not taxable if you never sell the crypto assets that you buy. And so all this applies to U.S. citizens at home and abroad. And now the author goes on to say that you can interpret this IRS memo as unofficial and unenforced and not pay your taxes for 2017, but you would be doing that at your own risk, and it would be a huge risk indeed. The second question here, are cryptocurrencies like an asset, like a stock, or are they a currency like the US dollar? And the answer is that they're like an asset. In the eyes of the IRS and the SEC, the regulatory bodies that matter in this case, cryptocurrencies are a capital asset. And you could read more about this in the memo that we're going to be referencing. How do people report their cryptocurrency capital gains to the IRS? How do I include this information in my 2017 tax returns? The answer is that we calculate the cost basis and the capital gains of every taxable crypto transaction that you made in 2017, and then you attach it as a separate statement to the Schedule D Form 8949. And so this could be a spreadsheet or something of that nature. And then you write in one row on Form 8949 containing the total capital gains and losses for those transactions in 2017, indicating to see attached statement below that. So the articles and the memos get into the details about what is the cost basis, and more importantly, how do you calculate the capital gains based on the cost basis. Those details will be in here. Additionally, how do you calculate the cost basis and capital gains together? Question 6, what exactly is taxable and what isn't? What are taxable events? And so every time you sell a cryptocurrency for a higher price than you bought it for, that's a taxable event. This includes times when you sell a cryptocurrency for US dollars, as well as when you sell cryptocurrency for any other cryptocurrency. It doesn't matter, it's still a taxable event every time you make that sale, no matter what you sell it for. Prices at the time of sale of a crypto for another crypto need to be calculated and converted back into US dollars at the time that that transaction is made. And so to help you with these calculations between the different exchanges that you may be using, there are different tools that some exchanges have. For example, Coinbase has some tools that help you. I think Bittrex has some tools that help you. Other than that, you can use tools like yaxreturns.com or bitcoin.tax, which we will also review. That's going to help you do those calculations and then bring that information to your accountant, your financial advisor to actually review that everything is accurate and in order properly. Because it's really important, as we see in question number 8, to understand how cost basis works. If you've transferred cryptos across multiple exchanges in 2017, you really have to understand all of these methods. You need to figure out what quantities you bought and sold these cryptos for, and at what basis for each of the quantities. And this is done typically using a method like FIFO or LIFO, first in, first out, or last in, first out. Other methods like that may be available, because it's unlikely that you're going to be selling one whole Bitcoin for one whole Ether or one whole Litecoin every time you trade. These are segments of coins with different volumes and different prices for every time a trade is made, and each of those need to be calculated individually. And again, not only is this important to understand between the different exchanges, but this is also important to understand how the capital gains work when the trades are happening between different fiat currencies, different cryptocurrencies, and intermingling between fiats and cryptos and multiple exchanges. There's a lot of transactions that some traders are creating for themselves, and it's important that each of these are tracked, each of these are added to a spreadsheet. Then all of these are calculated to get your final capital gains or losses for your 2017 taxes. So again, we've already referenced the IRS's official stance on crypto with the memo that they've released and have re-referenced, originally released in 2014, have re-referenced in the past year in August 2017. We know that if you do not pay your taxes, that you may be at risk, even if it's on an exchange that is overseas. If that exchange or when that exchange finally chooses to share their information with either the SEC or the IRS, then retroactively you could get in trouble for either not paying your taxes or underpaying your taxes, even miscalculating your taxes. You really want to make sure that everything is in order as great as possible, as clearly as possible. And then later, if we get amnesty, then we'll assumably be able to amend our returns for the previous years to take advantage of any of those changes that do end up coming about. Let's also keep in mind that Coinbase has been subpoenaed by the IRS, and the IRS wanted everybody's information because we know in 2016 only about a few hundred people, maybe 500 or 600 people, actually filed their capital gains for cryptocurrencies. And we know that there were allegedly millions of Coinbase accounts that were opened up in that same time period. So we know that the number of people who claim cryptocurrencies on their taxes should be much, much higher than 500 US citizens living inside of the United States of America or abroad. So this is becoming of greater and greater importance for the IRS to make sure that people are paying their fair share of taxes. And I think that we can expect to see the IRS come after more people and more organizations as more people and more organizations are investing and profiting in the cryptocurrency space. So if you get things situated this year and start understanding how all of this works this year, this is going to help you make better decisions, better trading decisions into the rest of 2018, and helping you understand maybe some trade might not be worth it because you're going to have to pay the capital gains on that trade. And if you're just barely breaking even, it might be better just to be a bag holder in that case, knowing that every time you trade, and it's not for the value of Bitcoin, as we talk about so often, people should be trading for the value of Bitcoin, not necessarily for the value of US dollars. And so what we see is that the amount of Bitcoin that you earn on a altcoin crypto trade could actually be losing money in relative terms to BTC, but maybe it gained value relative terms to the US dollar. And so it becomes even more unappealing to make some of these trades as we understand how taxes are going to be working for Americans. So which forms do you need to fill out for your 2017 crypto tax returns? Well, at a minimum, you're probably going to need a Schedule D Form 8949 if you bought or sold any cryptos in 2017. You're going to need to fill out this form. Additionally, there's also the Form 1099 MISC, and you would use that if you paid someone for services that cost more than $600 in 2017. And honestly, at this point, all those 1099 miscellaneous forms should have already been submitted by the end of January. So if you haven't submitted that form, you did miss the boat, and you can retroactively submit that form, but there is the risk of having huge fines and penalties if these forms are submitted late. So what information do you got to give your accountant or your CPA to get your taxes done? Well, you're going to likely need to calculate the cost basis and the capital gains of every taxable crypto transaction you made in 2017, and then give that to your accountant. You're probably going to give that in the form of a attached statement to the Schedule D Form 8949, as we discussed earlier, printing out that spreadsheet or giving it to them in the file to print out and attach with the tax returns containing the price and quantity of every purchase in every one of these transactions across 2017. And these will be denominated in US dollars, as well as the price and quantity of all of these different cells, again, in US dollars. And then from that point, your accountant would help you calculate the cost basis and the capital gains of these transactions, and to make sure all your forms are filed correctly for the IRS's approval for your 2017 returns, which are due probably around April 15th, if I had a guess. Last but not least, in this Q&A, a lot of people have been wondering if they're safe from paying taxes if they use the like-kind exchange trading concept from section 1031A1. And so previously, a lot of cryptocurrency holders and traders and tax advisors were saying that you can trade one cryptocurrency for another cryptocurrency because it's such a similar asset, there wouldn't be taxes on those transactions, on those exchanges. But the IRS did clarify this, and it limited the interpretation of section 1031 to only real estate, which cryptocurrency is obviously not. Thus, section 1031 definitely does not apply to cryptocurrencies anymore, if it ever even did in the first place. All right, so that's the high-level Q&A from this article. This here is the actual irs.gov memo, the N1421 PDF, which people reference over and over again. That stands for the Notice 2014-21. So Section 1 details the purpose, and the purpose of this notice describes how existing general tax principles apply to transactions using virtual currency. The notice provides this guidance in the form of answers to frequently asked questions. So a little bit of the background here for this memo is that the IRS is aware that virtual currencies may be used to pay for goods and services or held for investments. Virtual currency is a digital representation of value that functions as a medium of exchange, a unit of account, and or a store of value. In some environments, it operates like real currency. For example, the coin and paper money used in the United States or any other country is designed as legal tender that circulates and is customarily used as and accepted as a medium of exchange in those countries of issuance, but it doesn't have legal tender status in any other jurisdiction. Virtual currencies that have an equivalent value in real currency or that act as a substitute for real currency is referenced as a convertible virtual currency. Bitcoin is one example of a convertible virtual currency. Bitcoin can be digitally traded between users and can be purchased for or exchanged into US dollars, euros, or other real or virtual currencies. So for a more comprehensive description on convertible virtual currencies to date, you can see the Financial Crimes Enforcement Network, FinCEN, and their guidance on the application of FinCEN's regulations to persons administering, exchanging, or using virtual currencies, which is FIN 2013 G001, dated March 18th, 2013, to get that information. And Section 3 in the memo details the scope. So in general, the sale or exchange of convertible virtual currency or the use of convertible virtual currency to pay for goods or services in a real-world economy transaction has tax consequences, which may result in a tax liability. The notice here from the IRS addresses only the U.S. federal tax consequences of transactions in or transactions that use convertible virtual currency. And the term virtual currency, as used in Section 4, refers only to convertible virtual currency. No inference should be drawn with respect to virtual currencies not described in this notice. Further, the Treasury Department and the IRS recognize that there may be other questions regarding tax consequences of virtual currencies not addressed in this notice that warrant consideration. Therefore, the Treasury Department and the IRS request comments from the public regarding other types or aspects of virtual currency transactions that should be addressed in future guidance. And so then they give where comments should be addressed to the IRS mailing office or hand-delivered to the courier's desk, both in Washington, D.C. Alternatively, there's also an email, which seems a lot more convenient than having to hand-deliver or do snail mail to Washington, but whatever floats your boat, I suppose, right? So lastly here in Section 3, for the purposes of this FAQ and this notice, the taxpayer's functional currency is assumed to be US dollars. The taxpayer is assumed to use the cash receipts and distributed methods of accounting, and the taxpayer is assumed not to be under common control with any other party to this transaction. And so a couple different assumptions as the IRS does go through these FAQs. So then section 4 is the list of the FAQs, which you can jump in here and read at your leisure to further understand the clarifications of any of these points that are being made across these 16 different questions and answers. All right, so last but not least, there's a couple tools out there to potentially help you, help your CPA, help your accountant, help your tax prep person to help you understand these taxes and get these taxes done. Now, we have the FAQs from that article. We have the FAQs from the IRS memo. We also have a couple tools which offer no guarantees, but could help you organize information and make your life a lot easier. So there are tools like Yax returns. There are tools like bitcoin.tax, which we've heard a lot of very good things about. There are also full service, accurate, easy, and secure crypto tax preparation from Bitcoin and cryptocurrency CPAs. And these are people who will do all of the work for you, your whole tax returns, including the cryptocurrency portions of those tax returns. They're over here at cryptotaxprep.com. I'm not vouching for any of these services. I'm not vouching for Yax or Bitcoin.tax or Crypto Tax Prep, but I do know that these are services and tools that a lot of people are talking about, that a lot of people are sharing, and a lot of people are using to help them get their taxes done for 2017. Some of these we've heard about and read as a part of our U.S. Crypto Tax and Support FAQs crypto group that we're a part of. And we'll also link this group with you below so that you can reference this and ask questions as in this group, because maybe there would be someone in there who can help you answer those questions. Wow. So there we have our crash course of Bitcoin taxes, of cryptocurrency taxes, of virtual currency convertibles that people are using to buy and sell either goods, services, or other cryptocurrencies. They're making money. People are making money with cryptocurrencies. And a lot of people, instead of buying and hodling long term, they're taking those cryptocurrencies that they're making these gains on and they're spending them. They are selling them for US dollars. And as we understand very clearly, every single one of those transactions then becomes a taxable event. It's important to recognize that if you're making money in the crypto space, if you're mining, then that's going to count as income. And there's a lot to be aware of. There's a lot to pay attention to. And people are only going to have more questions than the number of answers that are given to us at this point of the game. The tax season is fast approaching, and as soon as we get past the 27 taxes, then people really should be thinking about their 2018 taxes before we even get through halfway of this year. A lot of people are making trades, and again, some of these trades may have a lot of hidden costs with the taxes that people are going to have to claim less than a year later, right? So there's a lot of information. Thanks for sharing this information with me. I'd love to know, what do you think about cryptocurrency and taxes? A lot of people don't want to pay taxes at all. Here, Puerto Rico has some huge benefits for cryptocurrency traders and cryptocurrency holders that move to Puerto Rico as their primary residence, but that's not an option for a lot of people. Not an option for me, probably not an option for you. So all of us are stuck with this situation where there's a lot of tax. I'd love to know what you think. Tap that like button if this information helped you and brought any new information to your world. Let us know if you have any questions or comments in the comments box below. And until next time, I'm glad that together we are minting coins.